Hey guys, welcome back. Patrick here. In this video, I'm going to show you two options I'm selling right now on companies that have very high premium. This is a great way to generate cash flow and build the balance of your portfolio without taking crazy risks, right? Much less risk than actually buying options. So I'm going to show you the different parameters of what I'm looking at and what the basic strategy is. And then also a quick update. You guys might have seen my community post on Monday. I've been working on some private videos and everything. I'm going to reveal more later on this week when I'm done, but there's a lot changing on YouTube right now. The revenues are literally going through the floor. So a lot of content creators have to either quit, and go find a job, or they're going to be starving making YouTube videos. So I'm not going to quit YouTube, but I do have to make some changes. It's just the way it is, right? For me, it is kind of like a business at the same time. So I'll let you guys know more when I have more details and I'm done with the videos. So now let's get into my computer. So this is the chart of what I'm looking at when I'm looking to sell options. So this is kind of like my grades. So 1% per month is pretty decent. It's kind of like beginner level. It's mostly on stocks that have less volatility. So if you guys want to start out, you can look at SLV, which is a silver ETF. I've done a lot of those, and since it's very pretty stable overall, right? You're not going to see those 50% swings like you see with some of the growth stocks. So you can actually go a little bit bigger on those, but it is a great way to learn how to get started. So 1% also often is going to be a little further out of the money, so less risk. Now, if you jump to 2% per month, that is a pretty good, right? You're going to be maybe a little closer to the money, and it's going to be on stocks that have just a little bit more volatility, but still very easy to do. 3% is very good, excellent. And then 4% per month, in my opinion, is top tier. The higher you go, the more risk you're going to be taking, right? So 4% plus, you're looking at stocks where there's a lot more volatility, you're getting closer to the money. So you are going to be taking a little bit more risk, and you need to know how to adjust, close your position, hedge your position, and all of that, right? So start small, start on SLV, for example, and then over time you can move on to stocks that have much higher premiums like this. 4% per month, think about that. That's 48% per year just selling options. It is a very powerful strategy. Now, another thing I want to say is that to calculate your break even, not everyone understands this. You're going to take the strike price, and then you're going to subtract the amount of money that you collected in premium, right? So if I'm selling an option at $15 strike price and I collected $1, well, then my break even is 14. So if the price stays above 15, then I'm going to be collecting the full amount. And if it stays above $14, right, like I would start making profit at $14.01, right? And then I like to sell covered calls on stocks where I'm not too attached to them. So here I'm giving you the example of MGM at $45, for example, right? This is a position I've had since December. I like the stock, but it hasn't really moved a lot. It's not really gone much further than $43. So $45 is pretty safe, but if it goes above that and I had to liquidate my shares, I wouldn't cry at night over that, right? I would just open another position, no big deal. So I call it kind of like my make me move price. If you guys ever browse on Zillow, you'll see some houses that have ridiculous prices that people set. Well, they're it's kind of like a no risk thing. If someone takes it, they'll be happy and they'll move. And if no one takes it, then, nothing changes for them. So that's kind of how I see selling covered calls. I'm not doing that on stocks that are skyrocketing. I'm going to do that on stocks that I expect are going to be mostly flat, maybe going down a little bit, up a little bit, but not tons of movement. Now, selling puts is a very good strategy, but I like to do that on stocks where I wouldn't mind owning them. I'm going to show you one PaySafe where I wanted to open a position for a while. I didn't really like it when it was at 15 or 14, right? But now it's at 11. That's a great opportunity to sell puts. And if for some reason, I have to take the shares, I'm not going to be upset about it, right? I'm going to have a very good price on it. So I wouldn't do that on stocks that I really don't believe in. For example, I'm not going to sell puts on Clover or Workhorse or companies where if the price drops and I have to take the shares, I'm going to be like, oh, what am I going to do now, right? So you're going to understand that with the two stocks I'm going to show you. All right, let's get into PaySafe. This is a company I reviewed on the channel a few months ago, and even though it's not my favorite stock in the stock market, I still think it has some potential, right? And the biggest thing it has going for it is that they've been around for the past 20 years. So this is a company that has a very, very strong floor. The odds that they're going to go bankrupt in the next 3 months is pretty damn slim, right? And also, even though we don't have 20 years worth of charts, I mean, it IPO'd at $10, and recently we saw that on May 13th, there was a low of 10.08 before it actually rebounded. Since then, it's been kind of in that channel between $10 and $12.50. Right? So I don't think this stock is going to really skyrocket or anything like that, but at the same time, I don't think it's going to crash to $5. We might see $10 again, but if we do, it's probably not going to go much further down than that. So that really lowers the risk for this play and selling puts on this company. Right? So when I'm looking at the different expiration dates and the different strike prices for this company, I look at the different ones, right? They only sell them every month, so you don't have weeklies on these. But what you have to understand with selling options is that time is your friend. And the Greek theta, which is for time decay, right? The closer the expiration date is, the quicker you're going to be capturing that time decay. That is extremely, extremely important. That means if you can sell like weekly premiums or weekly options, you're going to capture more time decay than if you're selling it 6 months out or 2 years out. It is a little bit more risky, of course, because you have less time to react, but at the same time, like if you want to really maximize, the faster expiration dates are better for you. All right, so keep that in mind. So I looked at October, January 2022, but in the end I settled for August 20th, which is about 5-6 weeks from now, 44 days. All right, so if you look at different not expiration dates, but different strike prices, so $12 would be in the money because currently the share price is $11.19, but $11 is out of the money, which is good for you. All right, so the bid and ask 90 cents, 92 cents. I actually sold 10 contracts earlier at 91 cents. So if you want to do the calculation for the break even, you do 11 minus 91 cents. That means my break even is $10.09, and I'm on the hook potentially for 1,000 shares. So the different possibilities here is if the stock price stays above 11, I collect $905 profit. And then if it goes down to 10.09, I break even. If it goes under 10.09, I would have potentially, unless I close my position, I would have to spend $10,090 and get 1,000 shares of this company. Would that be like super risky? Where is this company going to go, right? Are they going to drop to $9 or $8? Probably not. And worst case scenario, I could then just take my 1,000 shares and sell covered calls on them and get more premium. So that's how I'm playing PaySafe. I like this one, right? And if you want to calculate your profit, that's extremely important. You're going to go here, your calculator, you're going to do 91 cents divided by the amount that you're risking, which is $11 per share. And that's going to give you 0.082, which is 8.2%. So 8.2% in 44 days, that is above 4% per month. That, in my opinion, is an excellent risk versus reward for this play. And then next up is SOFI. You guys know I love this company. I do have a position in shares. I recently sold my warrants before they start to crash, and I do have to give credit where credit is due. I was watching one of Meet Kevin's streams, and he did talk about the premiums on SOFI, so I looked it up, and now I decided to open a position in it. So here's what's going on. Now that I actually sold my warrants, well, I do have, hundreds of shares of SOFI, but my position is smaller than what I would want it to be. So by selling puts, right, if the price stays up, I'm just going to get a pretty good return on my investment. But if the price goes down, then I'm going to add to my position at a better price, which is what I wanted to do anyway. So it is a win-win situation, right? Even if the share price drops to, I don't know, 14 bucks, I would still be happy with it, right? Because otherwise, right now, like if I wanted to buy shares and add to my position, I'd be paying $16.92, right? So the fact that I can get it cheaper or collect premium, like whichever way, whatever happens, I'm going to be happy with it. So if you look at SoFi, right, it has had a lot of ups and downs. Right now, it is once again in a downtrend. There is a lot of selling pressure. People are very, very concerned with the lockup expiring, and now that's going to cause like a lot of shares to be dumped on the market by different hedge funds. And we know that Chamath has paper hands after the Virgin Galactic fiasco. So all in all, there is a lot of selling pressure in the short term, but 3 months from now, no one's going to remember that, right? And this is a company that I want to be in for the long haul. So if you look at the different options for SoFi, once again, the closer, you're going to capture more premium. However, in this one, I kind of struck a balance. I could have gone with August, I could have gone with January 21st, but I decided to go with October 15th for this one. If you look at the different strike prices, 750 would have been preferable, possibly, right? But I just don't have a lot of confidence that it's going to rebound to 1750. I feel like we're going to be in consolidation phase for SoFi for several months now until they generate a little bit more revenues and everything. And let's say if they sign up multiple clients with Galileo and they start making more profits, then sure, you know, it might rebound. But in the short term, with all the selling pressure, I don't see it really skyrocketing or anything. So I decided to go out of the money at $15, and I did collect $1.87, which is the current bid. All right, so I opened, I sold 8 contracts of this one right here. So I would be on the hook for 800 shares if it drops under $15. So $15 minus 188, that means that my break even for this stock would be 13 and 12 cents. Would that be a pretty good price to buy SoFi? I think so. I mean, I would be very happy with it, right? This is a stock that I believe in long term. So if it stays above 15, I would keep the full premium of $1,512. So again, you want to calculate the potential return for this play. You're going to go here. You're going to do, okay, sorry, I got 188, not 187. So you want to do 188 divided by 15. See here, you're going to get 12.5%. And that is over 100 days. So that is over 3 months. Right? So if you do 12.5 divided by 3, it is once again about 4%. Right? And this, in my opinion, is the perfect play because, as I mentioned earlier, no matter what happens with it, I'm going to be fine. Like, I want to buy more shares of this company regardless. So guys, I hope you learned a little bit something in this video. All right, is this a strategy you guys are using already? Let me know in the comments. What do you think about the play on PaySafe especially? Let me know what you guys think. I'll see you in the next video pretty soon.